Withdrawing money from a retirement account can create a lot of confusion on your tax return. Is it taxable? At what tax rate? Should you withhold taxes? Will you have to pay a penalty? All that. These are all questions you need to be aware of before you decide to pull money out. If you're retired and need to draw money out of your retirement accounts, it's easy to just put that decision on autopilot and fall right into several potential tax traps. Honestly, the same applies if you're not retired, yet are facing a situation where you're going to pull money out of your retirement accounts. In both situations, you need to be aware of these tax traps and do some tax planning around them. Otherwise, you could find yourself paying thousands more in taxes than you actually should. The first tax trap is that the withdrawal could push you into a higher tax bracket. Now, this one seems a little obvious, but many people don't know what tax bracket they're actually in. And even if you do, it's typically unclear where the threshold is where you would slip into the next tax bracket. Let me give you an example. Say you're in retirement and you have just consistently been in the 12% federal tax bracket near the top. Well, it's time to buy a new car. So you withdraw $30,000 from your IRA, not thinking anything of it. But most of that would be taxed at the 22% tax bracket, meaning 10% more in tax than ordinary. To make matters worse, say you needed $30,000 for the car. Since you're now in the 22% tax bracket, you actually need to withdraw $38,000 from your IRA to leave you with $30,000 after taxes, meaning much more of your hard-earned money is being taxed 10% higher than usual. Some proactive tax planning and financial planning can help you with this by exploring different strategies, like staggering the withdrawals from your IRA into multiple years or using other types of accounts to fund the vehicle purchase. The point with this first tax trap is you need to be planning proactively. If you're in retirement and the person helping you with your investments doesn't know anything about your tax picture, you've got a problem. The second tax trap is the one that honestly scares me the most, and that is when your withdrawal from your retirement account actually creates new taxes. Yes, you should be freaking out. The new taxes. The main culprit here is paying tax on your Social Security, because whether or not you pay tax on your Social Security depends on the other income that you have. The details of this are probably a subject for another video, but if you're married and living on Social Security and say supplementing that with $1,000 a month, drawing out of your investments, then chances are none of your Social Security is taxable, and you're probably not paying any federal tax at all. If you then decide to buy that car for $30,000 or maybe put the roof on the house for $10,000, something like that, then that scenario suddenly makes your Social Security taxable, whereas it wasn't before. Another new tax is, what if that withdrawal out of your retirement account was enough that you're now into the second tier or the third pricing tier for your Medicare Part B? I had a friend of mine who was moving from one house to another and didn't want to have a small mortgage. So he withdrew a chunk out of his IRA to help cover the difference. And it caused both him and his wife to pay extra for their Medicare Part B for that entire year, costing them thousands of dollars. So you've got to be planful anytime you're drawing money out of retirement accounts, because creating new taxes when there otherwise wouldn't be any would be awful, right? The final tax trap that I'll hit is sort of a combination of the first two, and that is not having the right amount withheld for your taxes. If you're making a withdrawal from your IRA and you don't realize that it's going to push you into the next tax bracket, then you likely aren't withholding the right amount. Worse still, if that withdrawal now triggers more of your Social Security to be taxable, then you should be withholding even more as well. And if that means you're paying more on your capital gains tax, then you could be woefully under withheld. What's the problem with this? It could cause a revolving problem, because then to pay the taxes next year, you have to withdraw more money out of your IRA at that time, which causes the same problem for that year, and the cycle repeats itself. Additionally, if you don't withhold correctly for multiple years, if this becomes a pattern, then you may find yourself having to pay an underpayment penalty when you file your taxes. So those are the top 3 tax traps you need to be planful of when you're withdrawing money from your retirement accounts. Hopefully in retirement, but really anytime you're drawing money out of your retirement accounts. You need to be doing tax planning as part of your comprehensive financial planning to not fall into these traps. Plus, you need to know about these issues as well, which hopefully this video has helped you with that. If you're not already a subscriber to this channel, the Wise Money channel is all about helping you take your next wise step in your financial life. So hit that subscribe button below, turn that bell on for notifications. Leave a comment below, agree, disagree, thumbs up, leave questions. I will get back to every single question. All right, until next time, my name is Mike Bernard. Now go out and take your next wise step in your financial life.